Hey everyone, it's Doug the Retirement Guy with the monthly ETFs. We have a new one. This one actually came from one of our strong Patreon supporters and also a YouTube subscriber, JP Morgan Equity and Options Total Return ETF, better known now as JOYT. It's a new approach to equity investing, and they wanted to know what was our opinion on this fund. It's a brand new fund, came out in August of 2025. It does pay quarterly, which is I'm disappointed in, but it does pay quarterly. And now you got JEPI, JEPQ, and now JOYT. So how does it work? What's going on? We're going to dive deep into this, but before we do, I got to give a shout out to all of our Patreon supporters, our YouTube subscribers, our YouTube members. Thank you so much. And everyone else, if you're not part of the family, if you're not part of our group, don't be afraid to hit that subscribe button, hit that bell notification. We'd love to have you as a member of our committee. And if you can support the channel, you got the YouTube member way, you got the Patreon way. It is so simple to help support the channel. Notice to all viewers, past performance does not guarantee future results. This information is provided in the videos for educational and informational purposes only. It should not be considered financial or investment advice. If you need the investment advice, always contact a financial professional. So what is JOYT? I'm going to call it JOLT from the rest of the way through. The basics. JP Morgan Equity and Options Total Return ETF, JOLT, is a new actively managed fund with a unique approach to equity investing. The ticker is JOYT. It's, as I said, actively managed. It seeks total return. And the expense ratio is 0.35, aligning up with the JEPI and the JEPQ. The category uses the U.S. large and mid-cap equity companies, and it came out August 18th of 2025. The primary goal is to deliver a total return while aiming to reduce risk and lower volatility compared to the broader U.S. large cap equity markets. So they're going to have regular income from dividends from the underlying equity holdings. They're also going to have option premiums. So premiums generated from selling options recycled back into the fund to enhance the total return. And then you'll have capital appreciation. So growth from increase in the value of the equity portfolio over time. So the total return is basically working with the dividends that they collect from the underlying equities, plus the option premiums, plus the capital growth. So this fund is really designed, and you got to use the name, it is designed for total growth, not income. So the core equity portfolio strategy, the primary focus is the actively managed portfolio focused on well-established U.S. large and mid-cap companies. They're going to have asset allocations of at least 80% of the asset committed to equity securities and call options on the S&P 500 ETF indexes. The market cap distribution significantly concentrate in mega cap technology and growth names with a strategic tilt towards market leaders. So you will see that the equity allocation is 80% is going into equities, 20% in other assets. So looking at who are they dealing with, the top 10, which accounts for over 43% of the portfolio, will be the NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, Broadcom, Wells Fargo. Then they have the JP Money Market. Then they'll have MasterCard. So you can see the concentration is in those mega cap tech leaders. Significantly exposure to growth names includes financial and tech sectors. So the total holdings is about 112, and you can see the top 10 make up 43% of the holdings. So the option overlay strategy, JOLT uses an option overlay strategy to generate premium income that enhances the total return while managing the volatility. So the option strategy, seller call options on S&P 500 ETFs or index, generates option premium income, and premium is a key component to the total return. So the premium usage, the premium recycled back into the fund. So if any of you are really thinking, it's almost like they're dripping the premiums. They're dripping the premiums back into the fund, which will enhance the total return, which helps manage volatility. So when you have 80% of your assets in stocks and you're doing option overlay, selling S&P 500 call options, you add that into it, your enhanced total return again gives you the premiums plus the dividends plus the capital gains. So what are the key differences? Well, JOLT's approach to option premium differs fundamentally from traditional ETFs. JOLT's approach, the premium recycling. The significant portion of the options premium is recycled or dripped back into the fund. The total return focus aims to enhance overall growth and manage volatility. The volatility control uses options to smooth returns and reduce the risk. Long-term growth fosters steady compounding for the portfolio growth. A traditional income ETF takes those premium distributions, most option premiums, distributed as monthly income. So JOLT puts it back into the fund while traditionals pay that out as distributions. Income focus maximizes income distributions to the investors while they are trying to get just large growth, total return for their investors. The higher volatility, the less volatility management. So when you have high volatility, there's not much they can do in traditional ETFs, while JOLT is trying to control that. And immediate income provides more predictable monthly distributions from a traditional fund, while they're looking for long-term growth. So I like the bottom that we put down here was JEPI and JEPQ. Takes a lot of options income and pays it out to you, while JOLT uses those incomes to fuel inside the engine to try to smooth out the ride and growth in a total pie over time. So let's look at the comparisons between JEPI, JEPQ, and then JOLT. So JEPI is your income focused. It's income plus that lower volatility. It uses the large cap US equities and it's more defensive. Option strategy sell calls options to create the potential of income. And the goal is to distribute an active, attractive income and less volatility than the S&P 500. The JEPQ adds a growth factor to it. So the focus is on higher income and the growth tilt. They underline with the NASDAQ style tech heavy portfolio. The option strategy calls at NASDAQ type exposure and the higher yield, more upside potential, but also more volatility. JOLT goes to the extreme of the total return. The total return risk management. They use the underlying large and mid-cap U.S. equities with a strong presence of mega-cap growth and tech names. The option strategy calls on the S&P 500 or the index. The goal is to deliver a total return with lower volatility and beta than the overall U.S. large-cap markets, using dividends, option premiums, and capital appreciation together. So now doing a comparison next to each other and kind of just a different way of looking at it. So JEPI, we have an income with a lower volatility. It is a moderate risk profile using the S&P 500. JEPQ uses the NASDAQ style, has a higher income and a higher growth tilt, but it has a higher risk package. And JOLT is going to give you a higher total return, which I'm going to call it it's 100% for growth. And it's managed through the option overlay. So they're doing everything to give you growth, while JEPI is looking at income. JEPIQ is giving you higher income with higher risk. So the risk portfolio, the market exposure, JOLT holds major growth stocks like Nvidia, Microsoft, Apple, Amazon, Meta platforms, exposure to the value of the broader equity market fluctuations. The value decline risk, a downturn in the stock market will likely lead to a decline in JOLT's net asset value, potentially affecting investors' returns. Sudden market effects, major market distributions may lead to significant volatility and potential losses. But the concentration of that risk of the JOLT's top 10 holding over 43% of the portfolio gives it what we call a concentrational risk. The option strategies, though, is where it comes into the unique piece. The upside limitations. When you're selling call options, you're going to cap your funds. So the market may grow tremendously, but JOLT's going to have a slower growth pattern than the actual open market. But it also, now the positive is going to give you that crash protection gap if the market takes a major drop off. Now there's no guarantee of this, but no guarantee in the protection, but the way that things are built, you should have a comfort cushion across that. Plus, this being a very active managed account from the JP Morgan portfolio management team, the effectiveness of the stock selection and options is going to be very critical. The problem that we first face is JOLT is a new ETF with very limited performance history, making it challenged to assess its behavior across full market cycles. As I said, this only offer came out in August of 25. And the interest rate environment is limited data makes it challenging to understand JOLT will perform across the different interest rate environments. Market cycle testing. We have not had anything, no prolonged bear markets. We don't know exactly yet how this will handle over time. Based on JP Morgan's descriptions, JOLT is designed for investors seeking total return with option-based risk management. So this is not built for income. This is built to give you a total growth return over time. So retirement portfolio application. In retirement planning, JOLT can serve as a balanced growth component within a diversified portfolio, potentially alongside many more income type funds. So when I talked to them, I found that this is a great add-on to the JEPI and JEPQ, which was what they actually were looking to do. You put all three of these funds together, then you have income, you have high income, and then you have balanced growth across the board. So it gives it a different approach to traditional ETFs that you can now have 3 JP Morgan funds in one portfolio to perform. When I looked at the lineup of those, I see the difference going in already, with especially only being just a few months old. When we take a look at year-to-date numbers, JEPI is at 0.66% return rate. Now this is just return. This is not including distributions. JEPQ is up 4.31 and JOLT is up 7%. And they've all had the same dips, here in November. They've all come out of the dips very well. So right off the bat, it's showing the difference of why they added it. So the key takeaways and the future outlook, well, it's a total return focus. It's designed for investors seeking total return with risk management. It's a multi-pronged strategy, and there is that risk management. The performance monitoring, you're going to have to track this and how well JOLT performs in the broader markets. It's not enough information for us to say this is good, bad, or ugly. This is just educational to give you an idea that A, JOLT is available and what it's for. So questions for you to research. And here's the things that I have to ask the question after even doing my research. I have a lot of questions with this. The investment objectives. Does the strategy prioritize total risk with risk management, or are you seeking maximum income distributions? That's a question you have to ask yourself, is which one do you want? JOLT is going after the total return, not income. How JOLT may strategize performance given after its launch date? That's a question I have. How long are the time horizons? What's it going to do long term? How is the portfolio constructed? What's your risk tolerances? What's your return expectation if someone's putting all their emphasis into growth? And professional guidance. Consider discussing JOLT with your financial advisor to determine, does this align with your growth, or is this something new to add to a portfolio? Let me know your thoughts on JOLT. Is this something that you think will going to work into your portfolio, that you're looking for additional growth? Or is it just something that is for start?
Thank you for watching. Press the like button